Hi, my name is Jeff DeWeese, and I'm the Chief Investment Officer at Oric Capital Partners. One of the most powerful forces shaping the financial markets right now isn't the Federal Reserve, inflation, or artificial intelligence. It's demographics, specifically a milestone called Peak 65. Between 2024 and 2027, more than 12,000 Americans will turn 65 every single day. That's the largest retirement surge in U.S. history. Millions of people leaving the workforce and transitioning from saving to spending, from accumulation to preservation. And while this shift sounds purely social or demographic, it's already sending shockwaves through the financial system. When people retire, their investment goals change. During their working years, they chase growth, stocks, startups, risk assets, because they have time to recover from market dips. But as retirement approaches, the goal flips. The mission is no longer to build the biggest portfolio, it's to make sure that the portfolio lasts. That means stability matters more than speed. Income becomes more important than appreciation. Cash flow becomes king. The result is a massive reallocation of capital. Trillions of dollars are slowly moving out of high growth, high volatility investments and into bonds, dividend paying stocks, and income producing products like annuities or private credit. That shift in demand will reshape how different assets are valued. Companies promising explosive growth may find it harder to justify lofty multiples, while steady, cash generating businesses could see renewed attention. In effect, demographics are setting the stage for a more income-oriented market, one that rewards predictability and balance over speculation and narrative. This doesn't mean growth investing disappears, but it does mean the balance of power shifts. The engine of investment demand will increasingly come from people who are protecting wealth, not trying to double it. There's a deeper macroeconomic side too. Retirees spend differently than working households. They typically buy fewer durable goods and spend more on healthcare, insurance, and services. That change in consumption patterns could influence inflation and the structure of the economy itself. As the population ages, overall productivity growth may slow, labor markets could tighten, and public finances will face new pressures and entitlement costs rise. Even monetary policy might have to adapt to a world where older populations save less, spend differently, and depend more heavily on fixed income returns. The financial industry is already adjusting. Asset managers are rolling out new income-oriented ETFs, insurance products, and hybrid investment vehicles designed for retirees seeking steady yield. Banks and advisors are shifting messaging away from beat the market toward build reliable income. In the background, regulators and policymakers are grappling with what it means when such a large share of national wealth moves into drawdown mode at once. All of this creates an interesting tension. Markets are still being driven by themes like AI, innovation, and future growth, the kind of narratives that thrive on optimism and risk-taking. But underneath that excitement, the investor base itself is aging. The marginal dollar in the market increasingly comes from someone closer to retirement than to their first job. That subtle reality could gradually reduce the appetite for speculation, temper volatility, and shift how we value both companies and entire sectors. So while headlines focus on rate cuts, tech rallies, and inflation data, the bigger story might be this quiet demographic wave rolling through the economy. It's slow, steady, and inevitable, and over time, it could matter more than any quarterly earnings report or policy decision. The future of finance might not be defined by the next startup or the next bubble, but by something far simpler, the aging of the largest generation in history. As trillions move from growth to income, from accumulation to preservation, the entire rhythm of the market could change. In short, the future of finance may not be faster or flashier, it may just be older, steadier, and a lot more focused on what really lasts. As always, stay calm, stay diversified, and stay positive. From all of us at Oric Capital Partners, we wish you all a great day.